Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to remeasurement, consolidated net income, and stockholders' equity. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including journal entries, worksheets down below, and then we have our remeasure trial balance, which has our beginning numbers that are in a foreign currency that we're going to remeasure to the dollar. Let's take a look at our information on the left. We have the remeasurement, journal entries, consolidated net income, and stockholders' equity. That's what we'll be doing here. On 1/1x4, P acquired all of the outstanding stock of S. So P is going to be the parent. S is going to be the subsidiary. It's going to be a Norwegian company, so therefore it's going to have their books on we're going to have a foreign currency kind of thing that we're going to have to deal with. We paid, and when I say we, I typically think of us as the parent company, paid $155,000 for the common stock of the subsidiary S. S, the subsidiary, had net income in foreign currency. Foreign currency is going to be represented by the NOK, whereas the dollar is going to represent like by the dollar sign. So that's how those things will be shown typically. $700,000 for the net assets of the subsidiary at the time of purchase. The book and fair values of the subsidiary are the same except for, so this is going to be our differential information, property, plant, and equipment valued over book. So property, plant, and equipment was $20,000 worth more than it was showing on the books. So then we have the remaining life. It's going to be 10 years. We're going to have to deal with the depreciation related to that. Remainder of the differential is not going to go to goodwill, but rather to the patent, which is going to be an intangible asset that we will then have to amortize over the life of 5 years. So S, the subsidiary, uses FIFO inventory method, and the beginning inventory was purchased on 12/31/X3, ending inventory was purchased on 12/15/X4, purchase in 2000/X4, the current year that we will be consolidating, $430,000 of the foreign currency. Then S purchased all property, plant, and equipment on July 1st, 2000/X2, so that's prior to the consolidation, prior to the purchase, P purchasing the outstanding stock, and the consolidation, which is going to be done. We're going to be doing consolidation or working this problem as of 2000/X4, end of 2000/X4, year ended 2000/X4. So then the subsidiary sales and expenses incurred evenly throughout the time period, throughout the year, we're assuming income and expenses incurred evenly. And then on 7/1/X4, dividends were declared. So the dividends were declared on 7/1/X4 for the subsidiary, that should be. And then P income from its operations was $237,000. So this is the parent company information, which is in dollars, which should be more straightforward for us. And then the parent company stockholders' equity was $3,600,000, and then the dividends for the parent company was $130,000 in dollars. Then we have the exchange rate for the relevant dates here, comparing the foreign currency to the US dollar. We have the US dollar is the functional currency. Now, this is what's going to be a little bit different than prior practice problems that we have seen. Remember, we got the subsidiary. The subsidiary is in another country, and they're preparing their books in the foreign currency. So their books are being in the foreign currency. We see their trial balance is going to be over here on the right. We'll take a look at that shortly. But it's been determined that the foreign currency isn't actually their functional currency because they're kind of more dependent, more linked to the parent company, possibly, right? That would be the reasoning for the functional currency now then being the dollar. So the functional currency is going to be the dollar. Therefore, rather than having translation, we have the remeasurement from the foreign currency to the US dollar. A little bit different in the technique that we're going to have there between translation, which is typically what you would think would be the process, and the remeasurement, that being dependent on what the functional currency is, and in this case it is the dollar, even though the books are being done in the foreign currency for the subsidiary. So we're going to make a schedule for remeasuring the trial balance I'm going to just change that right now, from the foreign currency, which is going to be the kroner, which I'm going to forget all the time. So you could, I'll probably just say foreign currency a lot. I hope that's okay. And to the US dollar. So that's what our process is going to be. So let's go over here. First, we're going to do that in our trial balance. We're going to use our remeasurement in the trial balance. Now, to see this a little bit more easily, let's hide some cells first, some entire columns we're going to hide from E to J. So I'm going to put my cursor on E, left click, and go on over to J. So edge, from edge and right click and then hide. Okay, so then we have the remeasurement worksheet. We got a trial balance. We're not going to be posting journal entries to this like we normally would in this kind of normal format, but rather using the applicable rates that we can use in order to remeasure, not translate, remeasure from the foreign currency to the US dollar. So obviously we have the assets in green, liabilities in orange, equity in the light blue, dark blue, the income statement. Okay, so what we need to do is just decide what the exchange rate is going to be. Now remember, like, I'm just going to go through the thought process really quickly, and then we can get into this process, right? You might think, okay, I'd like to use one exchange rate because that would be the easiest thing to do. First thought process, if you were thinking about this, would probably be, let's just use the exchange rate at the end of the year because that makes sense for the balance sheet accounts. So let's just do that first. We're not going to do it exactly this way, but let's just assume that were the case. We're going to say, all right, let's just take like the exchange rate at the end of the year at 1231x4, which is this 0.21. And then if we were to copy that down, what I'm going to do is F4 absolute reference this thing, F4 $ before the C, $ before the 37. Copy this and paste. Let's just use the autofill thing. Autofill. Okay, went too far. Autofill down to there. That's it. Okay. And then I would like this column on the right to be this times this, right? So I'm gonna do this. I'm gonna say this is gonna be equal to this number times this number, and I want to copy that all the way down. So I'm gonna right click. I'm gonna copy that. I'm gonna paste it down to here. I'm gonna paste it just the formulas only because I don't want to make them all green. If I do that, I want to just do the formulas to have that nice coloring. So we'll do that, and so there it is. So that would put us in balance. So that would be nice. In other words, it would be nice for us to be able to say there would be one rate that we're just going to use for the entire thing, but not typically the case. Why not? Because this makes kind of sense for the balance sheet accounts, but you can think of other rates that might make sense in certain areas. So for example, you might say, well, that makes sense for the in balance sheet accounts because they're as of a point in time at the end of the time period. But what if you like made a large purchase of property, plant, and equipment? Maybe we should be using some kind of historical cost there, maybe. Right? Depends. You could, right? And then, or like, what if we look at the income statement where we're not measuring at the end of the time period, but rather we have a time frame from beginning to end. So in that case, you would think we might want to use like some kind of average. We should have some kind of rate that represents the average in that case, or, that represents the time period from beginning to end, which wouldn't be the exchange rate at the end of the time period. So for that reason, we're going to say, well, we're not going to do this then. We'll keep it for the balance sheet up top, that we'll just use that ending date like for the balance sheet. And then we'll have some exceptions to that. One of those exceptions could be on the property, plant, and equipment. Now, again, this might be different from a remeasurement to the translation. So we might do a different thing when we're doing the remeasurement and the translation, in other words, in this case. So here we're going to be using, I'm going to delete this and delete the related accumulated depreciation, and I'm going to say this rate, instead of using the end rate at the end of the time period, I'm going to use more of a historical type of rate, and I'm going to be using the rate as of 11x4. That's the rate that P used when P purchased the subsidiary. So at the beginning of the year, because we're saying then all this property, plants, and equipment had been purchased, as it says somewhere over here, before the time period that P purchased the subsidiary. The parent purchased the subsidiary. So we're going to use the purchase date because that's kind of like a transaction. That's a market transaction. So we're going to basically use kind of more of a historical cost in that when the purchase took place, when P purchased the subsidiary, which is going to be that 0.18. And we'll do that for the property, plant, and equipment, as well as the related accumulated depreciation. So we're going to pick that up here as well. So we're going to be using those. Now I'm going to color code these rates so that might be a little bit easier to see for these items. For normally the balance sheet items, I'm holding down Control to color different non-adjacent cells. We usually make these a different color. Let's make these green because I got that. Make these green. And then I'm going to make this one green down here. We use the current rate as of the end of the year typically there. So we're going to be making this one green. And then on the yellow, we've got a little notes on the yellow that says 8.18 is the date the subsidiary was acquired. So the date the subsidiary was acquired, I'll make these yellow. Let's make that yellow. And to go along with that note, that's nice and colorful. Looks good. And that's going to be this item. All right. So then we're going to go to the common stock. Now we're in the equity section. Now the equity section, the common stock hasn't changed since last period because there were no more stock issued because all the stock was purchased, at the beginning of the year because it's owned like 100% by the parent. And the retained earnings is the same that it was at the beginning of the year because we haven't, this is a trial balance and we haven't closed out the income nor the dividends to it. So this retained earnings is really the retained earnings at the beginning of the year. So note that as we go through this, I'm kind of jumping to the end here just so you can see the end product as we go through this. We're going to put some rates as we work through it, and then we're going to go back to some worksheets and then come back to here and adjust some of the rates. So some of the rates that we're going to adjust, this one, this 0.205, we're going to adjust that later. So just note that we're going to finish up here, go back to the worksheets, and then we're going to adjust that. And then this one, obviously, we're going to have to go back and adjust. And then this one is one we're going to go back and adjust at a later time. But if you want to see what they are now, this is going to be the 0.205 for the inventory, more of a historical rate. We'll talk more about it later. This one, we're going to have to use a calculation to calculate it. And this one is going to be using that more of a historical rate as well for the depreciation on the income statement. So these two, we're not going to use the end year rate. We're going to use the beginning year rate. Now be careful with the retained earnings because obviously the ending retained earnings has different components to it. It's got the beginning retained earnings, this number, the dividends, and the net income that you'd have to calculate using the different rates. But we have those pieces and components broken out here, this being the beginning retained earnings. So I'm going to use the rate at the beginning of the year or the end of last year, which we have. So down here, we have the same rate for the end of last year and the beginning of this year. I'm going to take this 0.18, which is the first day of the current year, which is the point in time that the consolidation took place. So I'm going to take that same 0.18. I'll do the same thing here, and let's make those yellow as well. So I'll make those yellow to indicate that. Then we got the dividends. Now the dividends, just like with the remeasurement method and the prior method is the same for this one as well. That it was kind of the same for these two items too. And the balance sheet accounts, this was the differing factor from the translation to the reimbursement. But the dividends, same thing. We got to take up the rate as of the point in time that the dividends went out. So that's it's the same thing as the translation and the remeasurement, I mean. So the dividends went at 7.1 x4. So that at that point, the rate was 0.19. 0.19. Let's make that a different color. I'm going to make that blue. Let's make that blue. I've determined that needs to be blue, and we'll make this blue just to tie that out. Then we've got the income statement. Now the income statement, we will be picking up the average rate because this is basically the average because we're talking about a beginning and ending time frame here. So we're going to be picking up the average rate for the income statement. So this is the rate that best represents the time period from January all the way through December, right? We need a rate that represents the whole thing. And then here I'm going to F4 this or absolute reference this. I'm going to go into it and say F4, put a $sign before the C, a $sign before the number, in this case 38, so that I can copy that and paste it without it moving the cell reference down. I'm skipping the cost of goods sold. We're going to come back to the cost of goods sold, and I'm going to paste it down here, not to the last one, to these two. All right, there we have. Now this one, we're going to have to come back to. These three, I'm going to make another color. Let's make that orange. Orange. So we'll make that orange. And then, so then we just got the cost of goods sold. We're going to have to put together a little worksheet to get to the cost of goods sold. And once we get to the cost of goods sold, we're going to be out of balance because we use these different rates now. So, and we're going to have to then adjust for that. We'll have a reimbursement loss this time, a reimbursement loss due to the fact that we're having a remeasurement as opposed to a translation. Okay, so now we're going to unhide some cells, and we'll get back to here. We'll get back to here later, but I'm going to unhide some cells. I'm going to highlight or select, we should say it's a better term, from C to K. C to K, from here to here, from C to K, let go, right-click the selected area, unhide. So now we've got our information once again unhidden, and we can then go through some of our calculations and journal entries. Now we're going to do the equity method journal entries for the parent company of the subsidiary up top. But before we do so, let's go through some calculations down below, including a calculation that'll get us to that cost of goods sold number that we can use to complete our remeasurement. So we're going to go to P's consolidated net income. So P's consolidated net income, we're going to calculate this. We're talking about the parent company now. So P income excluding income from S, this is given to us from the parent side, which is going to be straight in dollars. So no weird things happening here. This is just in dollars. We're going to pick up that $237,000. Then we're going to add to it the income from S. We're going to add to that the income from S. Now that is going to be over here on the trial balance. And that's going to be the amount that we're going to get to down here. So before we get to that, we're going to have to figure out the cost of goods sold. So let's stop there for this table. Let's go down to the next table where we will then be calculating the cost of goods sold. Let's go ahead and label this cost of goods sold. All right, so let's do that. And I'm going to put another we'll keep it there. Cost of goods sold. I actually had another subcategory, cost of goods sold here. So it's cost of goods sold, which we'll label it twice. Then we've got the beginning inventory. So we're going to be picking up the beginning inventory for the cost of goods sold. We're going to have it in the foreign currency, then use the exchange rate, and then get to the dollars. So it's going to be a couple different rates that we're going to be using in order to get there once again. So we're going to get to the beginning balance. Now notice what we don't have right now is the beginning balance. So I'm going to use the same formula for cost of goods sold. Beginning balances plus purchases gives the cost available for sale minus the ending inventory is the cost of goods sold. But we're going to be backing into the item that we do not have, the factor we don't have, and that's going to be the beginning inventory. So I'm going to leave that blank for now. Then we're going to go to the purchases because we know what the purchases are. They gave us the purchases. And so I'm going to put that over here, and that's going to be equal to, I'm going to go to the left. And we're going to be picking up the purchases, where did they gave us that somewhere. I'm pretty sure they gave us that. Oh, here it is. That's going to be the $430,000 in the information. So we've got the purchases in foreign currency. That's going to give us would give us the cost available for sale if we had the beginning inventory plus the purchases. I'm going to go ahead and indent these. It'll be indented for you already. And so that would give us the cost of goods available for sale, and then we would subtract out the ending inventory. I'm going to indent this, and the ending inventory should be on our trial balance. So I'll pick that up from the trial balance over here. And that's going to be this item. So the inventory in foreign currency, the 281. And that's going to give us then the final calculation of the cost of goods sold. And I will indent that. Now, we already have the cost of goods sold. It is going to be in foreign currency, this 425. So we have that. So we're going to back into the beginning inventory. So to do that, we know that if I have the available for sale minus the ending inventory, it should equal the 425. So I'm going to then add these together, the 425 plus the 281, and that's going to give us the 706. And then if we had the beginning inventory plus the purchases should give us the amount available for sale. So I'm going to back into this amount by saying the 706 minus the 430. So then if I was to do this normally, I would say this number plus this number is going to give us the 706 cost of goods available for sale. Cost of goods available for sale would be this number minus the ending inventory to give us the 425,000. Okay, so then we can use our rates now because we're going to use different rates because now we're going to say the beginning inventory, we should be using the beginning rate at the beginning of the year. So I'm going to use the beginning rate. I'm going to use this 0.18 again for that to convert it over. But the purchases, we're going to be using then the purchases, the average rate, because we're going to use the average. which is the 0.2 there. So we'll multiply that out. The 430 times the 0.2 conversion. Then if we were to add these up, equals the sum of those items. We get this, and then the ending inventory, we're going to use the rate at the end of the time period, which was the balance sheet date rate, the 0.205. Multiplying that out, we get this times the 0.205. Then we're going to say the 135,680 minus the 57,605 gives us the 7875. So notice what we did here is we did the cost of goods sold basically using the foreign currency, and then we adjusted using what we believe would be the most appropriate rate for each component of the cost of goods sold to get to the cost of goods sold we think that should be reported in the US dollars based on the remeasurement. And now that's what we're going to use over here. So now we're going to use that to calculate this cost of goods sold. So this number is I'm just going to directly put it in here. And then I'm going to say that, this equals that. Basically, I'm not going to, and I'll make this, let's just make it a little bit larger. So there we have that. Okay, so we're just basically basing it on this calculation. So this number, we can make it maybe just red because it's unusual. And we'll say that's coming from here. Okay, hopefully that is not too confusing. Okay, we're going to make one more adjustment here, and that's going to be for the inventory. Now remember, the inventory, we use the ending balance sheet date, but it gave us in the data on the right-hand side, it gave us in the data that the inventory, ending inventory was purchased on 12/15 X4. So we're going to use a historical rate then, instead of just the ending balance sheet rate for the inventory. So we're going to say, okay, that's another kind of large purchase or fixed asset component. So we're going to use the historical date similar to what we did in the property, plant, and equipment. So I'm going to be picking up then a different rate here. This is going to be the rate at, what did I say, 12/15 X4. And so there we have that. I'll make this a different color now. So this is a more colorful one than last time. Let's make this lighter, like that color. So we'll make this that color. And then make this that color too. This is that color. Okay, so there we have that. Now we're out of balance by the 410, and we're going to actually make one other adjustment here, and that's going to be the depreciation. The depreciation expense, notice on the income statement accounts we used the average rate, but for the depreciation we're going to be using that same 0.18, basically kind of like the historic rate. So I'm going to be picking up the 0.18 here. So I'm going to be picking up the 0.18, and so there we have that. Okay, so there we have it. And so now we're different. We're off by 1,450 because of course we've been using all these different rates. Now that 1,450 is going to be an adjustment that we're going to have to make. And where are we going to put it? Where are we going to put that adjustment? We're going to call it just a remeasurement loss. Again, note this is different than what we did when we did the translation. So I'm just going to plug this number in here, 1465, so it shows up in our remeasurement loss. Now we're in balance, debits equaling the credits. Our net income now from a cash perspective is including the remeasurement, not loss. It's not going into comprehensive income or other comprehensive income. Therefore, we're at the 39,315 of income. So that's going to be our income at this point in time. So now we can go to our worksheet and we can add the income here in our P consolidated net income. I want to make it a positive number. It's a negative number on this side, so I'm going to say negative of, and then we'll pick up that 39,315. So there we have that. Then we're going to have the adjustments. We're going to subtract out the adjustments for the differential. Now the differential we're going to have to calculate down here. We're going to have some adjustments for them. It's going to be a little bit more complex than possibly we've seen in the past. So let's calculate the differential, and that's going to be the difference between the amount that the parent company paid and the book value that we're going to apply to as they gave us to the depreciable assets, property, plants, and equipment, and then the intangible asset, that being a patent. So we're going to start down here. Let's go down to this worksheet where we have the differential down below. We're going to say, all right, differential. We're going to be picking up the differential. We're going to start with the investment cost, which was in dollars. So I'm going to put that in the outer column. It's going to be a straightforward number, no problem with that one. That's going to be the $155,000. Then we want to take a look and compare that to the book value of the net assets at that point in time. So net assets at that point in time. However, the net assets are going to be in foreign currency units, which we will have to convert. So let's pull that into the inner column here. Pick up the amount, which was for that 700 foreign currency units. And then we're going to take a look at the exchange rate at that point in time. The exchange rate at January of that year, which is going to be that 0.18 we've seen so often on January 1st, 2000 X4. And then we'll multiply that out, and that'll give us the book value of the net assets in terms of our units of measure, of course, the dollar. We're going to say this will be equal to the 700,000 times the 0.18. So now we can then compare the amount that we paid versus the book value, and that'll give us our differential. So our differential will then be equal to the 155,000 that we paid and the 126,000, both in dollar currency units at this point. So then we have the differential, which we are going to apply out to 1, the property, plant, and equipment, the depreciable assets, which they told us was greater than what was on the books. It was greater by $20,000 in U.S. currency. So this is going to be the 20,000 here that we're going to apply 20,000 of that 29,000 differential here. So 20,000 of it goes there. And then the difference is going to go, they said, to not to goodwill, but to a patent, which is another intangible asset that we're going to have to depreciate or amortize, I should say, over time. So 29,000 differential minus the portion that goes to the depreciable assets gives us the amount, the 9,000, going then to the patent. So once we have that information, we can then go back up top and we can think about our adjustments with relation to the differential, which is a little bit easier for us to calculate than when we had the translation. So we're going to have depreciation and amortization now. So now that we're at the U.S. currency, we're going to pick up simply the depreciation adjustment for it, which is going to be, and I'm going to make it a negative by saying negative of, I'm going to pick up the 20,000. That's going to be the, remember that represents the depreciable asset over what it was on the subsidiary's books. And we're going to have to add that and then add the depreciation related to it, which is the 20,000 divided by the useful life, because it's a straight line that we're going to be using here, which is 10. And that's simply going to be the 2,000. The amortization, same kind of thing. We'll do the same thing for the amortization. And we're going to be picking up then, I'm going to make it a negative by saying negative of. We're going to pick up then the 9,000 divided by the useful life for the patent, which was 5 years. So again, this is a easier calculation than we saw in the prior problem with the translation. Then that's going to give us the consolidated net income. I'm going to sum these up, which is going to be this plus this minus this minus this, and equal 272,515. So we're going to say equals the sum of this plus minus this minus this, 272,515. Now you might ask, like, why is this different, than it was with the translation? If you think about it, and this is my justification for the reason that they have it, that it's going to be different. So, right, I mean, if it's and it comes down to, of course, the fact that the functional currency here is the U.S. dollar. So if the functional currency, like if it should have been the foreign currency, like if they're doing business within the foreign currency, you would think that you would have to then calculate it back to the foreign currency and then use the proper exchange rates. But if the functional currency is the U.S. dollar, then it would make sense for us to simply take the differential basically in terms of the U.S. dollars and divide out by the number of years using the straight line method. So remember here, the functional currency is the U.S. dollar. Therefore, we're doing a remeasurement to the U.S. dollar as opposed to a translation, which means that we should then do the calculation of the depreciation in the functional currency, which in that case would have been the foreign currency, which it's a little bit more complex to do. Okay, so then the next thing, let's go to the consolidated. Let's just work the consolidated stockholders' equity, and then we'll go back up top. So the consolidated stockholders' equity is, we're going to start off with this calculation. P stockholders' equity at the beginning. This is the parent company. They're going to give this to us. So we're going to say this is going to be equal to the 3,000,006. Then we're going to add to that the consolidated net income. Consolidated net income, which we calculated up top here to be 272,515. So we're going to be picking that up. This will be the 272,515 that we worked out in our prior problem. We're going to subtract that by the dividends then that were P, the parent company's dividends, which are given to us in dollars. This is going to be equal to, these are all in dollars. I didn't put the dollar sign here, but these are dollars. And then we're talking about the consolidated stockholders' equity finally is going to be down below. I'm going to make this number a negative just so it'll subtract, and we'll use the sum function. So I'm going to make this a negative, so it's going to be this plus this minus this. I'll do that with a sum function equals the sum of, it's going to be this and this and this, which will subtract the 130,000. There's the 3,742,515. Okay, let's go on back up top here. Now we're just going to record the journal entries that the parent company would record using the fully adjusted equity method. So we would start off with the straightforward transaction, normal equity method stuff, and the investment in S. Investment in S, and the other side is going to be going to cash for the investment that went into play. It's straightforward because cash was paid, so cash is going to be going, or the investment's going to be going up, and cash would be then going down for the initial investment on 11X4. Then we're going to pick up the dividends. So we're going to say dividends, and I'm going to put this into cash here for the dividends. The dividends were paid by the subsidiary for 52,000 in the foreign currency, which we're going to have to exchange into our currency. And note, again, if we receive the 52,000 in foreign currency, then we would record it on our books as units of foreign currency, some kind of asset and investment, but still have to remeasure it to US dollars so that we can measure whatever assets we have in our measuring tool US dollars. Or possibly we can exchange it, and we might have a recording of a gain or loss due to the exchange, and then have the cash, right? So I'm going to put cash in our example here, but notice that the remeasurement would happen either way, whether it be cash or to the foreign currency in units. We'd still have to measure the thing either way in dollars, one way or the other. So we're going to say there's going to be that transaction. Then we're going to have normally the income that we're going to have to be recording from S company's income that we're going to record using the equity method for the parent company here. The income we have now calculated, we've remeasured to be this 39,315. Note that it does include the remeasurement loss that we had to take into consideration as we did the remeasurement process. That's going to be the number that we will then be using here. So I'm going to be picking up, I'm going to say negative to flip the sign. So there is that on the debit and the credit. Then we're going to have our adjustments due to the differential effects of the depreciable property and the amortized property. So those are going to be our transactions that look like this. We can do this with one entry, or we can do it with two separate entries. I often do them with two separate entries. They're going to be picking up the depreciation and the amortization we calculated down below. So I'm just going to say, all right, this is going to be negative of that 2,000 for the depreciation. It's going to be debiting the income from S and crediting the investment in S. And we'll do the same thing for the amortization. Amortization, same journal entry, again, oftentimes combined together for the full differential effect. I think it's easier to see to break them out. And there we have it.